Have you ever wondered how mutual funds actually make money? You invest your money, but where does the profit come from? Is it magic or is there a simple logic behind it? Let's understand this in the simplest way. Mutual funds collect money from many people and invest that money in different assets. When those investments grows in value, investors earn returns. First one, investment in stocks. First one major way mutual funds make money is by investing in stocks. Stock represent ownership in companies. When a company performs well, its stock price usually increases. If a mutual fund buys shares of the companies whose value increases, the overall value of the fund also increases. Now we will see the real life example. Suppose a mutual fund buys shares for 100 rupees per share. After some time, the price increases to 150 rupees. That means the fund has gained 50 rupees profit per share. This profit increases the value of the mutual fund. Second one is dividend income. Another way mutual fund make money is through dividends. A dividend is a part of the company's profit paid to shareholders. If a mutual fund owns shares of the companies that pay dividends, the fund receives this money. Now we will see the real life example. Imagine a company gives 5 rupees dividend per share. If the mutual fund owns 10,000 shares, then the fund receives 50,000 rupees as dividend income. This income becomes a part of the total return. Third one is interest from bonds. Mutual funds also invest in bonds. A bond is like giving a loan to a company or government. In return, interest is received. Now we will see the real life example. Suppose a mutual fund invests 10 lakh rupees in bonds with 7% annual interest. Then the fund earns 70,000 rupees every year. This income increases the overall value of the mutual fund. Fourth one is capital gains. When a mutual fund sells an investment at a higher price than the purchase price, the profit is called a capital gain. Now we will see the real life example. If a fund buys a stock at 200 rupees and sells at 300 rupees, the 100 rupees profit is a capital gain. Such gains add to the total returns. Fifth one is increase in NAV. NAV means net asset value. NAV represent the price of one unit of a mutual fund. When investments inside the fund grow, NAV increases. Now we will see the real life example. If units are purchased at NAV of 20 rupees and later NAV becomes 30 rupees, the value of the investment increases. This increase shows the profit generated by the fund. So here is the simple summary. Mutual funds mainly make money in three ways: growth in stock prices, dividend income from companies, interest income from bonds. All these profits increase NAV. When NAV increases, investment value also grows. Mutual funds invest in many assets and are managed by professionals. Because of this, mutual funds are popular for long term investing and wealth building. So, in one line, mutual funds grow money by investing across different assets.